Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
On today's Bloomberg Intelligence Show, we dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we'll take a look at the Federal Reserve's rate path for 2025 and how the incoming Trump administration could affect the economy. Plus, we'll take a look at some of the companies our analysts are keeping an eye on in the new year. But first, we dive into the health of the retail industry in a price-sensitive climate. Guest host Caroline Hyde and I sat down with Bloomberg Intelligence senior retail analyst Jennifer Bartashus for a look ahead at the retail space heading into the new year. Here's a portion of our conversation.
One of the things that we're looking at is really the consumer is doing well, but it's about where is their focus, and the focus is on value. And so what we're seeing is across the entire industry, a lot of retailers trying to reorient their operations in a way that presents value, however that might mean to their core consumer. So for Nordstrom, you may see that pivoting in terms of the way they do their assortment, but for retailers like Walmart and Target, it's about price and it's about selection.
And there's a great story on that, Jen, on the Bloomberg Terminal. Leslie Patton and Jaewon Kang have this story. The headline's just a great headline. Kirkland for Christmas. Shoppers ditch logos for store brands. That kind of goes to your value argument. How do you see that with the stores you cover?
Yeah, value is as I said, it's of utmost importance, but private label had a great year in 2024, and we actually see that momentum just continuing in 2025. So Kirkland is Costco's own brand. It is over 30%, almost 35% of their sales, and it is just a trusted brand to the point where consumers no longer think of it as a private label alternative to national brands. They just see it as a brand in and of itself. Walmart, Target, Kroger, Albertsons, these companies have all invested in private label in the last several years. And it's really starting to pay dividends because it's value, it's novelty, and it's something that consumers are really resonating with.
To get that data, to understand that it's resonating with the consumer, they're having to be leaning into all the data points largely through digital investment, I'm sure, and through artificial intelligence. How is that something that they're not just plowing money in, but getting the rewards back?
Yeah, the rise of retail media is really the answer to that question. And when we look at the industry, actually last year, we made a prediction that retail media would be up by over 20%, the revenue associated with it for 2024. And it looks like we're going to exceed that. And it's on pace to continue that kind of momentum into 2025. So retail media is really advertising. And it's the selling of ad space. It's the selling of search results. And it's on digital products such as you see online, as well as digital screens that you see in stores. And so retailers have really been unlocking the value of that and are finding that it's a way to bring a high margin, very low overhead business into their mainstream core.
You know, Jen, that's a business, for better or worse, I have experience with. Back in my banking days, we tried to finance a bunch of those companies because we felt like, just like you said, they're captured customers. They're at the point of buying. What a great time for video to be introduced there in terms of advertising. What does it mean for the big retailers? What are the economics to the big retailers for this media?
So this media carries a margin of 80%, and when you think about retail staples, you're talking about operating margins in the 3 to 5% range, right? You're talking about gross margins in the high teens, low 20s. So the ability to have a revenue stream with such a high margin is very appealing to these companies, and they have the data. They have all this first-party data that they can monetize, and so it really is a very effective partnering. And one of the interesting things things that we're finding is that there's always been historically investment from, say, packaged food companies into retailers for placement on shelves and things like that. But we're finding that retail media is actually incremental spend. So that's actually an even bigger tailwind for these retailers as they get deeper into this new revenue stream.
In many ways, everyone takes a leaf out of Amazon's book in the end. I'm interested, Jen, a little bit more about the pure data side of it and the forecasting side of it. We go to you to help us forecast what the retail looks like. How are the companies themselves forecasting in 2025?
Well, it's been interesting because what we've really seen were in 2023 and 2024, we saw some initial pilot cases of the use of AI, for example, to help with demand forecasting. And we're seeing that those pilot programs have been successful and are being more widely rolled out across organizations at places like Kroger and Walmart and Target. And what that really means is that they're getting more efficient and smarter about understanding when they need product and where they need product. That then goes all the way back up the supply chain and makes them more efficient as an organization. And so, that kind of cost-cutting initiative is good from a operational perspective, but it's also good for customers because that means that what they want will be in the stores or online available at the time they want it.
Our thanks to Jennifer Bartashus, Bloomberg Intelligence Senior Retail Analyst. She spoke with me and guest host Caroline Hyde. Now we pivot to how mortgage rates will impact the health of the housing market. Alex Steele and I spoke with Drew Redding, Bloomberg Intelligence U.S. homebuilding analyst, starting with his prediction for the housing market in 2025.
Yeah, so as you can imagine, the direction of mortgage rates obviously is going to be key in determining how the spring selling season unfolds and how housing ultimately fares in 2025. I mean, if we go back to September, we were looking at a rate at around 6.1%. There was a lot of optimism heading into next year. But that quickly unwound. We're now looking at rates at about 7.1%. So monthly payments are that much higher for buyers out there. So we think it's going to be hard to build a lot of momentum with the affordability challenges that are still out there in the market. That being said, we think that the broader housing space can still grind higher in 2025, with the existing market returning to growth, maybe in the low to mid single digit range, off an extremely depressed base. Remember, we're coming off back-to-back years at around a 4 million annualized rate, which is the lowest in more than a decade. So off of a low base for sure. In the new home market, we think you'll see similar growth, but we think the backdrop will continue to favor the large, well-capitalized, publicly traded builders who have access to financing, access to land, access to the trades compared to their smaller private peers who tend to rely on that regional and local banking for financing. So they've really struggled with the cost and availability of that capital. So we think you'll see a bifurcation of growth continue to play out.
Drew, I'm going to ask you a 30,000-foot question about housing market here in the United States. We're told that there's a housing shortage. A, is that true? B, how did we get there? And what are your building companies going to do about it?
Yeah, so I think the issue right now is that there's a shortage of homes on the market. A lot of that has to do with the fact that people are locked into a much lower mortgage rate, so they're disincentivized to put their house on the market and trade up to a new home and take on a much higher rate. At the same time, you have to remember back in 2020, 2021, when money was cheap, you had a lot of people going out buying second and third homes. You saw a boom in the Airbnb market. So I think, the housing stock has been allocated in a different way than we've seen historically, which is contributing to that shortage. Now, in terms of what the builders are doing, it's going to be hard for them to put a lot of new supply onto the market, particularly as supply in the resale market starts to heat up. So we think you'll see new home production maybe increase in the low to mid single digit range, which kind of corresponds to what they're seeing from the demand side. But, we don't see the issue with housing being solved anytime soon.
I love how we talked about low rates. Thanks a lot. This is my moment where
this
we
is
talk
your
about
moment.
my 275, 30-year fix, and then Paul complains about not being able to refi, and then all the really cool conversations. So then we can, move forward on that combo. The problem is with your builders, as Paul calls them, is that they wind up building, but it's still too expensive for people to buy it, and then they wind up having to give incentives, and then that winds up hurting their profitability. How long does that part of the cycle last for?
That's a great point, Alex. And that's actually one of the key themes for 2025. While we think that volumes will continue to rebound. It's going to come at a cost for the builders. The use of sales incentives is at a multi-year high. A couple months ago when we were looking out to 2025 and we had mortgage rates coming down to the 6% range, I think there was a lot of optimism that builders were going to be able to pull back on that use of incentives, which would support margins into next year. But it's been exactly the opposite. So, we think sales incentives are going to remain elevated. We think margins will come under pressure next year. And it's not just incentives. I mean, you have higher cost land running through the P&L, and you have the potential for tariffs and some immigration policy to add to the margin pressures that these guys are going to face next year.
All right. So a home was just constructed right next to me down at the Jersey Shore. It's being constructed as we speak. And I'm guessing it's swarming with workers there. I'm guessing some percentage of them are illegal immigrants. What are the builders telling you guys about a tighter immigration policy might mean on the ability to actually get these things built?
Yeah, there's some estimates out there that immigrants comprise about 30% of the entire U.S. construction force. And as you mentioned, a large portion of those are undocumented. So in the event that we do get some policy coming through next year that puts a strain on that labor force, I think what you're going to see is a pullback in production. I think builders' closings could be impacted because you're going to see cycle times, which is the amount of time from start to completion. You'll see them start to elongate, and that could pressure closings. At the same time, builders are going to have to start to fight more to attract that labor. So you're going to see costs rise as well.
Right. So that says a profitability squeeze, it feels like, on lots of different ends. Which companies in your coverage universe do you feel like are best equipped to manage that?
So there's a couple things that we're looking at. One, from a geographic perspective, we think that's going to become increasingly important in 2025. Some of the markets that are struggling a little bit, think of Texas and Florida, where you're seeing a lot more competitive supply. We think builders in those markets are maybe going to have to adjust prices or continue with the elevated incentives. So we think from a geographic perspective, you're likely to see relative strength in the Midwest and the Northeast and maybe pockets of California. From a product perspective, with rates rising, you have to think about who's most impacted by that. And as you would expect, it's the lower end or the entry-level home buyer. So we think that they could remain under pressure into 2025 with relative strength in that move up and luxury segment. So some builders that come to mind would be a Toll Brothers or a Taylor Morrison.
Our thanks to Drew Redding, Bloomberg Intelligence U.S. home building analyst. Coming up, we turn to the Fed's rate path for 2025. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. For my colleague Alex Steele, I'm Paul Sweeney. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We look next at the macro environment after the Fed lowered its benchmark policy rate by 0.25 percentage point earlier this month and signaled just 2 reductions for 2025. San Francisco Fed President Mary Daly said she was very comfortable with 2 rate cuts in 2025. She spoke about the Fed's rate path on Bloomberg recently with hosts Jonathan Ferro, Lisa Abramowitz, and Michael McKee. Here's a little bit of their conversation.
We have to remain agile. I mean, the thing that's got us here is being resolute to achieve our dual mandate goals. Price stability was our focus when inflation was very high. The employment has come into the frame so that we're focused on both. But then we also have to be agile. The world is uncertain, so we pencil in 2. And, as that estimate or that projection gets further from when we made it, the accuracy of it probably falls. And so we're just going to continually take in more information, consider it. And every meeting, your listeners should think about this, every meeting is live from the standpoint that you're debating, you're discussing, you're thinking, what's the right level of policy? But my projection is that it will take many fewer rate cuts next year than we thought, but I'll watch the economy and see if that works out.
When we went into the cutting cycle, you were out front and saying you were concerned about the labor market and that we needed to make sure that we didn't lose the gains that we had. Now, Absolutely. At least coming out of Chairman Powell's press conference, it sounds like the the focus has shifted to inflation again. Are you comfortable with that as this new phase that he's talking about?
Well, I think of it as a new phase as well, and I would characterize it slightly differently. I would say that for a long time, a persistent amount of time, protracted, we were focused almost entirely on inflation. That's because the labor market was quite robust and inflation was 7, 6, 5. That was the right way to focus. Then the labor market came into the frame. That didn't mean we turned our focus totally to it. It just meant that after a long period of focusing only on inflation, we were now focused on both. I think that is still the case.
That's Mary Daly, president of the San Francisco Fed, talking with Jonathan Farrell, Lisa Abramowitz, and Michael McKee. For more on the Fed's path forward and how the new Trump administration might impact the economy, Caroline Hyde and I spoke with Macro Perspectives founder and president Julia Coronado. Here's a portion of our conversation, starting on her thoughts on the Fed's messaging at the December meeting.
Their messaging that we got at the December meeting was a lot sterner than expected, with only 2 cuts and just a general tone of concern about inflation. And I think, when we look at the data that's come in, it's fair for President Daly to say that, it's the data have been disappointing on the inflation front. But this wouldn't have really happened if it weren't for the risks to inflation in the outlook. And they can't really pinpoint them or put too fine a point on what's likely to happen. But every major policy prong of the incoming Trump administration could potentially be inflationary. So you can see they released their assessment of risks to inflation and unemployment, and the change in upside risks to inflation really moved at the December meeting. So we don't know the specifics on policy. Yes, we have to wait and see what materializes and how that feeds into the data, but there's a direction of travel here that's of concern to the FOMC broadly speaking. This was a big move across a lot of participants. And so, they want us to be on watch for that.
Have you been running the numbers and with a best case, worst case scenario? Yes, we don't know the direction exactly of where policy will go, but we've been on this rodeo before and there's been tough talk about tariffs in the past.
Yes, and we got tariffs in the past, and we did see them flow through into goods prices. The difference was that we were in an environment in the first Trump administration where inflation was running low and in fact below the Fed's target. So they could be very sanguine and patient and sort of accommodate the increase in goods prices that came with the trade war. This time around, we're in a different environment. They've just reestablished credibility. They've just brought inflation back down, not even to their target yet. And so, the threat of a round of tariffs and an impulse into goods prices is more meaningful. Now, the thing that they're going to have to grapple with, and we saw that also in last trade war, is trade wars also destroy demand. That spike in prices isn't good for consumer purchasing power, and it's unlikely to be accommodated like it was during the pandemic with a lot of fiscal support to households, directly to households, which helped the economy weather the inflationary shock during the pandemic and sort of stay on track. In the first Trump administration, we actually saw the trade war dampen economic activity, put the global manufacturing sector into a recession, and the Fed actually ended up cutting rates in 2019 to take out some insurance against that manufacturing recession broadening into the service sector. So, very different circumstances. This could weaken the economy. It could cause inflation. It could do both. And then the Fed's mandates go in different directions, and they have to make a judgment call.
Julia, so, tariffs are clearly an issue. What I've heard from a lot of folks is restrictive immigration policies, perhaps forced deportations, that impact on the labor market, that might even be even more inflationary going forward. How do you view that risk?
Yeah, no, absolutely. And I think that is definitely something we are likely to see. That is one of the main promises of the campaign, and we can already see the appointees and the plans being put in place to implement this policy. And let's not forget that immigration, that plentiful flow of immigration, while it became a political hot potato during the election, it's unambiguously positive from a macroeconomic standpoint. We had abundant labor supply. It helped growth, it helped demand. So immigration is good for the economy, and to even just turn off the spigot, let alone turn around and, cast a shadow over the labor market and deport some workers, it's going to change the macro environment. And yes, in areas where the most targeted population, the undocumented workers, are employed, food services, construction. I have conversations with people here in Texas, people in the real estate industry that are pretty worried about the availability of workers as early as next year, as early as the spring building season. So this could be very material. It could bring higher prices. It could also just slow down building activity because you just don't have the people that you need. Similarly, for food, availability of certain crops and the prices of those would likely spike. So leisure and hospitality, another industry that relies heavily on an immigrant workforce. We could see that ripple across numerous sectors in the economy. And it could be, by mid-year, we're seeing some material constraints and some price increases on the back of that.
And Julia, it kind of goes to that consumer confidence number we got today. Came in, weaker than expected, and the expectations looking forward were weaker than expected. That actually surprised me because I've been talking to a lot of our guests since the election about a palpable sense of optimism in this country since the election, particularly as it relates to economic outlook, reduced taxes, and so on and so forth. How do you think about the consumer and consumer confidence? Did that data surprise you today?
So I was just digging through those details. And of course, the optimism depends on who you ask. So you're probably talking to a lot of market participants who have experienced the rally and are looking forward to maybe reduced regulation in the finance industry, maybe some corporate tax cuts. But when you look at consumers, well, there's a lot of uncertainty as to how this mix of tariffs and immigration is going to affect more the average consumer. And when I looked at actually what was interesting, you could see a little bit of a political footprint here when you look at it by region. The Conference Board doesn't have the breakdown by political party like the Michigan sentiment measure does, but you can clearly see sort of the South confidence going up, but in the West and the Northeast, the confidence going down. So, we are a 50-50 country. We always have been. Some people are feeling better. Some people are feeling a lot worse. And it really depends on who you ask.
What about stockholders? Because, boy, 2024 should have been the year that made everyone feel pretty good. It's if you've been long AI, if you've been long S&P, NASDAQ, bigger benchmarks. And then it just tails off in the last couple of weeks. So how did sentiment around being an asset holder right now feel?
Yeah. Well, that's what was interesting about the numbers, right? It was the expectations component, not the present situation. We have been on quite a tear in the stock market. And of course, you all know that it's been very, very concentrated in a handful of names that are related to the AI, sort of euphoria. But now we're moving into the expectations meets reality phase of a change in administration. So by the end of January, we're going to know a lot more about this mix of policies. And some are growth positive. And some are growth negative. And so different industries are going to experience that differently. The tax cuts, I think one of the things that we just saw with the budget dogfight is that it's a lot easier to talk about tax cuts on a campaign trail than implement them in a very closely divided Congress. And even within the Republican Party, while they hold majorities in both houses, there's a lot of different views on the correct direction of fiscal policy. So we sort of imagine it's going to take most of the year to legislate anything meaningful on the fiscal front. They want to push forward a border package early. We'll see how that plays out. I assume they're going to be able to get a lot done. But remember, again, very different from last time. Budget-wise, the U.S. fiscal position is a lot worse than last time. And so that room for maneuvering is a little tighter, and their ability to enact something that's really going to change the backdrop is more limited.
Hey, Joy, about a minute left. How do you put in Elon Musk into your calculus here?
Elon Musk is going to be a noise generator at a minimum, and certainly will be, as we saw with this budget fight, fighting for things that are good for his companies. But I think what we also saw in the last week is that he's not going to just get his way. He's going to talk a lot. Do I think he's actually going to be successful eliminating the VA health care system? No, I do not. So, he's going to run into constraints. He's not an elected official. He actually doesn't have any sort of direct lever that he can pull. And these elected officials have a lot of views about the programs that they want to protect. And their constituents that they want to serve. So I think it's going to be messy and loud and harder to extract the signal from the noise.
That's Julia Coronado. She's president and founder of Macro Perspectives, speaking with me and guest host Caroline Hyde. Coming up next on the program, we look at the companies analysts at Bloomberg Intelligence expect to do well in the new year. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
As we wrap up 2024 and look ahead to 2025, we wanted to bring in Bloomberg Intelligence Research Director for Content, Tim Craighead. His latest piece covers the 50 companies to watch this coming year using analysis from Bloomberg Intelligence. Let's dive into our conversation with Tim, starting with how he and his team started work on picking companies and sectors they think will do well in the new year.
Across our team, we are thinking both on a bottom-up and a top-down perspective about this topic. On a bottom-up perspective, we encourage all of our analysts to step up with their high-conviction ideas where they feel like they've got something that's out of consensus or different from what the market's thinking, and make a focus idea. And we have a list of focus ideas. There are about 90 of them right now that are these high conviction differentiated ideas where we see catalysts ahead that can bring the market around to our point of view. From a top-down perspective, looking across those groups of companies, you can think about it. Is it US or European or Asian oriented? And actually this year it's pretty well balanced from the standpoint of, yes, you'd think the US is close to 50%, and then Europe and Asia are roughly about the same. And you think about where are the ideas that are positive versus negative. And, this is roughly 80% positive, 20% negative, to coalesce into 50 that are really driven towards 2025 as we see catalysts play out. And you have to say it's really interesting because you compare versus last year, where there were big AI ideas, and there was a lot of focus on negative China, especially with the property market. This year, there's much more orientation towards ideas about cyclical recovery with a change in interest rates and sort of clarity on elections. And the China side of things is also much more recovery oriented, not so much worried about the property crisis. So we can get into some of the details, but that's a backdrop.
So we still have AI still a thing, China recovery, cyclical recovery. What are some other buckets or themes that were reflected throughout the picks?
No, it's interesting thinking about it this way. There's definitely an innovation, new product flavor that we should talk about and get into. There's 4 new CEOs, but with those, we see a couple that are positive, a couple that we've got some concerns about, not the CEO themselves, but the situation of the company that they're in, that, maybe there's more work to be done than the market's thinking about. And there's energy transition related ideas as well that cross the globe, notwithstanding policies and whatnot coming from new governments. So those are some of the bigger buckets.
So what's the call here on the energy transition? It feels like here in the States, Tim, it's kind of losing a little bit of its steam, but I know it's still going strong in other parts of the world. How do you guys kind of think about that? So
a couple of things here. Number one, AI, and we can talk about this too, because we have a little different take this year than last, but AI is driving energy demand, and there is simply no way that we can fulfill the demand that is going to be required, or even is required today, with good old-fashioned carbon-based energy. And so if you look at RWE, it's a European utility, but they bought Constellation in the US. And a lot of that is oriented towards clean energy growth and demand that's AI driven. The same thing is true with Subsea 7, which they do construction on offshore energy projects, and instead of good old fashioned drilling for oil, a lot of the stuff now is oriented towards offshore wind and even some solar. And TEPCO, Tokyo Electric Power, is a nuclear story where Japan is now turning nuclear back on, and that's going to drive earnings.
Hey, Tim, a lot of great names in here, a lot of great themes that you guys have held out. I think one of the stocks that's getting investors' attention is Broadcom, and they're calling out their AI exposure. How do you guys at Bloomberg Intelligence think about AI? What companies are you highlighting for Bloomberg clients as it relates to AI?
AI has 5 names on our list of 50. So, you think about it, it's 10% of the list. That's a pretty big deal. And it's also interesting in that it's a different set of names than what we had last year, where we also had a good bit of exposure. That was bigger sort of core AI names that you think about with large language models and whatnot, and some software companies. This year, it's much more about some of the enabling technologies, and primarily in the world of semiconductors. And that's exactly where Broadcom sits. I heard you talk to Kunjan a few minutes ago. A really interesting combination of semi and software in that company that, is providing, enabling chips. But Cadence Design is the software company behind the design of semiconductors. KLA makes test and measurement tools that you can't do this high-end semiconductor stuff without. Micron is making high bandwidth memory chips, which, again, you have to make AI work. And then there's the odd one out is a company called VAT Group. They make vacuums, and it's like super high-end vacuums that create the vacuum in which you make semiconductors. So lots of interesting different kinds of plays.
I did not know that either.
Yeah.
What about the innovation part? So I appreciate that AI dovetails with innovation, but aside from AI, what are some companies that can really fit that bucket?
Well, I tell you, there are some really interesting ones there. We can't talk about innovation without talking about something in biopharma. Last year we had Lilly and we had Novo Nordisk. This year we've put AstraZeneca forward. They've got a host of new data sets coming out in cancer and in respiratory disease. You can tell I've been here in London so long. I say respiratory as opposed to respiratory. So
okay,
anyway,
we'll make fun of you.
Yeah, exactly. There's another healthcare one. Insulet. They have what's becoming the standard of care in wearable insulin patches, the Omnipod 5. And, that's a pretty cool story that's growing gangbusters. You got a couple of car companies, and it's because of new products. Call it innovation, because it is. Tesla is going to launch their low price car at some point in the first half of the year that we think makes sense. And Porsche has 5 cars that are in process. A couple have been announced, a couple are coming, but importantly, they're hybrid 911. And, those are going to, pardon the pun, drive really important revenue growth.
And folks,
just one last thing I would throw out to you guys. We were talking about the business yesterday, the banking business, now the other. IMAX. We all like movies. This is the theater that you're going to go and actually see a real movie at, because you've got the monster screens. And there's more American theaters installing them, but they're also going abroad. And talking about dating ourselves in yesterday's conversation, I actually worked on that back at Goldman in 94, I think, when we took them public. So, it's been around a while, but there's accelerating story.
So let's start with the cyclical recovery, because if I look at the list that you guys have, that's really the bucket where you're seeing a lot of the stocks highlighted. Give me an example of what kind of company would work in this theme of cyclical recovery?
There's a broad view here of elections are over in the US and in Europe. There's some clarity. Central banks are cutting interest rates at least a little bit for a while. We'll see how long it lasts. And all of that should provide some better backdrop in terms of sentiment. And with that, you could see labor markets improve a bit, which plays into Workday, which is a human resources software provider, and Adecco, which is one of the larger placement recruiting companies. So that's an example. There's also home building that plays into this. So one of the big UK home builders is a company called Persimmon. And then you've got, retail and other consumer product related companies. Think Tapestry. Tapestry makes Coach, the great, handbag and other clothes. And they've also got Kate Spade. And if we start to see some improvement in the consumer space, then that plays into, a cyclical story in addition to what Tapestry is doing specifically. So things like that.
Hey, Tim, as you well know, during your long career on Wall Street, a lot of what investors and traders do is try to figure out where the consensus is. And do I have a different view than consensus? If I do, then I'll buy the stock or sell the stock short and so on and so forth. You've identified some companies where you think there might be risk to that consensus. Give us a name or two there.
Yeah, so this plays across regions. It plays across sectors. We just talked about some consumer ideas that we think can do better. You've got Estée Lauder, however, that we think is still misfiring in some of its core brands. So that's on the cautionary front. Nintendo. I think pretty much everybody knows who they are. They're supposed to be in the midst of an upgrade cycle with a new console, the Switch 2. That's been long delayed. We think the delays continue, and we think you've got earnings disappointments there that will happen. There's a lot of AI hype, and expectations are huge. And, clearly we have AI-related names on this list. But Palantir is one of those that's smaller in scale when it comes to large language models and really high expectations. We think the company is very well placed, but we think expectations are probably too aggressive. And so we've actually got concerns on that sort of consensus front, as you rightfully point out, Paul. Those are a couple that come to mind. It's interesting. We've got a lot of China stimulus ideas going on here, and this might be a little far-fetched for some of the U.S. listeners, but we also have a negative view on Shanghai Airport. Traffic is coming back. There is a lot of traffic, but a lot of their earnings actually come from the duty-free sales that happen in the airports and the rent that they get off of that. And people just aren't buying as much when they travel as they used to, especially Chinese. They're buying it online or they're going to stores, not necessarily the airports. So there's a lot of different ways to think about this.
Our thanks to Bloomberg Intelligence Research Director for Content, Tim Craighead, for joining us. Find his latest work, 50 Companies to Watch in 2025, online at Bloomberg.com and on the terminal. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. For my colleague Alex Steele, I'm Paul Sweeney. Stay with us. Today's top stories and global business headlines are coming up right now.